In a previous video, we talked about inflation, and we talked about how the investor really has to learn to think in real terms, adjusted for inflation. And then when you look, for example, at housing prices in real terms, you learn that over a course of 120 years, housing prices have barely changed. All this focus on inflation may lead you to ask, well, where does inflation come from? Because if you can answer that question, you might get a better feeling for where it might go in the future. And Milton Friedman, the famous economist, has said that inflation always and everywhere is a monetary phenomenon. And what he means by that is inflation is always produced by government creation of money. But do we want to just take Milton Friedman's word for it? Maybe we can look at some data that will help us understand what Professor Friedman had in mind. And here's the key. Most of the real things in the economy, like the number of people working, or the amount of capital equipment, or even real GDP itself, those can only change by a few percent per year. 10% maybe in extraordinary circumstances. But as we're about to see, inflation can change far, far more than 3 or 10 or even 100% per year. And if inflation changes by a dramatic amount, we can then look elsewhere in the economy and say, what else changed by that amount? And we'll be able to see if Professor Friedman is right. So let's take a look at the data.
So if we're going to investigate what causes inflation, the easiest way to carry out that investigation is to look at examples where we had really serious or hyperinflations, and then to see what moved along with those inflations. So let me give you 3 examples and then tell you what we find. Here's one. In the early 1920s, the German mark and the US dollar were about equal in terms of value. And then Germany began to experience a hyperinflation. And by the end of 1923, 1 US dollar was worth 4,200,000,000,000 marks. And the earlier bills, as the picture shows, were virtually worthless. They were kindling wood. To give you an example of how extreme that inflation is, the current U.S. deficit is $14 trillion, U.S. government debt. If we experience the same type of inflation that Germany did, that entire debt could be paid off in terms of current dollars for about $3.50 a year hence. But that's not even the biggest inflation. Here's an amazing one. After World War II, Hungary had such an immense inflation that the currency became trash. The pengo went from about a value of 10 to the dollar to 4.6 times 10 to the 29th per dollar. That's such a huge number, it's hard to even think about. It's on the order of the number of atoms in your body. But that means that the entire U.S. deficit could have been paid off for less than a penny 1 year hence. Now you may say, well, these things only happen in the past. Not so. They're going on currently. For instance, in Zimbabwe now, the cost of an egg has risen from about 100 Zimbabwe dollars to 50 billion Zimbabwe dollars. So, these are situations where the inflation rate was millions and millions of percent per month. So, all we have to do is look for something that had a similar rate of growth. And if you look at these 3 economies, there was only one thing. The amount of effective money provided by the governments of those countries. Nothing else approached changes of this order of magnitude. So these hyperinflations show that Milton Friedman is in fact right. Inflation is everywhere and always a monetary phenomenon. And the reason you need to be aware of this is that because inflation is a monetary phenomena controlled by governments, when you're doing your investing, you always have to worry that inflation may be around the corner. because political behavior is so unpredictable. So in the next lecture, we're going to talk a little bit about how asset markets take account of and reflect inflation.